Hey everyone, happy Thursday, October 2nd. It's about 9:20 in the morning on the West Coast, and it's time for another market update. Well, rates have been trending in the right direction. Things were starting to get to the point where everybody's feeling pretty optimistic about things. And we had to go throw a curveball into things, and the government is in a shutdown as of, I think, Tuesday night or Wednesday morning as of, midnight. So let's take a look at how that's going to affect things, in our world. First of all, the length of the shutdown that's going to impact it. If they come back tomorrow, there's not going to be much impact at all. This last weeks to months, then obviously that's going to have a bigger impact. Right now, the CBO is estimating about 750K furloughed employees. Private government contracts may not get paid. And here's the thing that's really gonna, bug me. We're not gonna get the BLS jobs report. We're not gonna get unemployment claims. We won't get CPI. We won't get PCE. We won't get census type stuff. So there's a lot of this reporting that the markets, go off of, that are driven off of, that we won't be getting as long as the government's shutting down. So, the data was starting to come in our favor. Jobs were starting to look a little weaker, and so forth. So that's a big deal on our side of things because, basically on the market side, we just won't know what's going on with jobs, with inflation, and whatnot. Next thing. So the last time we had a full government shutdown, we had a partial one a few years back, but the last time we had a full government shutdown, it lasted 16 days. And at that point, the CBO estimated that there was about a loss of negative 0.6% in our annualized GDP, which is a pretty big number. And I know that I saw this morning that Treasury Secretary Scott Bessent came out and said, a prolonged shutdown would affect our GDP this year. So again, not necessarily a positive for our economy, but that's not a bad thing for mortgage rates. Like we've talked about it, any sort of weakness is a better chance that the Fed will cut rates. And last time they estimated there was about 120K private sector jobs lost when they were shut down for 16 days. Again, that's private sector, not government employees. And any sort of weakness in the job market, which we'll get into in a second when we look at the job numbers, is good for mortgage rates. So those things could be beneficial to us in the mortgage world. However, there is some impacts just on the technical side. VA, FHA, USDA loans could be delayed. USDA, it seems like they're pausing them completely. Things like FEMA flood insurance and stuff like that could be delayed. Tax transcripts, getting tax stuff from the IRS is going to be way delayed with this. So, and that could delay closing. So not a good thing on that end. But as far as how this could affect mortgage rates and what's going to happen, it might end up being a positive just because it's bad. And like we've talked about, anything that's bad for our economy tends to be good for rates because there's more likely chance at that point that the Fed will cut rates. So now that we're done with reports, it takes even more importance on these reports we did get this week. So going back to last Friday, we got the August PCE, which is the Fed's favorite form of inflation, and it came in as expected. Month over month, the headline was up 0.3, core up 0.2. Bringing the headline to 2.7% year over year, and the core to 2.9%. Again, their target is 2% with this core, so we're still above that. But we are having some, they think there's a slight increase because of tariffs, just for the short term. That should go away. But overall, it wasn't surprising, and that was a good thing for us. Any sort of bad surprises would have been bad. A good surprise would have been good, but at least it came in as expected, and nothing really came of that. Next thing, it's actually jobs week. So the first one we got a couple days ago was August JOLTS, so job openings. They came in about expected. The estimate was about 7.2 million job openings available. It came in at 7.227 million. So more job openings, the stronger the economy. So again, we would have preferred that came in a little bit lower, but that's not a big market mover overall. Next thing we got was September ADP. September ADP, that's private payroll. And this came in really weak once again. The estimate was 50,000 jobs created. It came in at negative 32,000, so negative job creation. The previous report was revised from 54,000 to negative 3,000. So again, this looks really weak. This is, again, kind of what we wanted to see. All the job gains were from large businesses, and all the job gains, when you break it down by sector, was coming from education and health services, which isn't necessarily as volatile when it comes to stuff that's going on in the economy. Job stayers actually went up a little bit in wages. Job switchers dropped quite a bit from 7.1 to 6.6%. So that one came in really weak. Generally, the big job report that we get this week is the BLS jobs report. That's the market mover. That's the one that's killed us, but actually came out really weak this last month for the month of August, and we're not going to get it. That's something that comes from the government, like I mentioned. So we're not going to get these job numbers on Friday that shows us unemployment numbers, shows us, job creation. And again, it's kind of been starting to, weaken up a little bit. So that's something we wanted to see. That would have kind of, if that came in weak again, that would have been good for rates. So again, that's one of these negatives from this government shutdowns. We're just not going to see these numbers. Next thing, so we got August pending home sales, and these it was actually up, and this was before rates really dropped. End of August, they just started to drop, and it was up 3.8%. I think last month it was just up about 0.7%. I'm sorry, it's up 4% month over month. Year over year, it's up 3.8%. So still low, still obviously higher rates is keeping this down where we'd like it to be. And again, this is people that went pending in the month of August, so they got an accepted offer in the month of August. So the very end of the month, like I said, that would have been when rates started to come down. So we might have seen the benefits of rates coming down, and it will be really interesting to look at September, the month that just ended, because that's when rates really started to drop. So especially the beginning of the part of the month, we might have seen really a big pickup in people getting into contracts. So we'll have to take a look at those numbers when they come out next month. Next thing we got. So we got a lot of reports. So thankfully, because we're not going to get any more for a while, appreciation. So we got both the Case-Shiller and the FHFA. Case-Shiller is the gold standard. Case-Shiller seasonally adjusted came in at negative 0.1%. Non-seasonally adjusted was actually down negative 0.2%. So that's depreciation. So home prices actually dropped in the month. And again, this is for the month of August, or I'm sorry, July. This is always a little bit behind. Year over year, though, still up 1.7%. So again, we're gonna have to keep an eye on this. It's again slowing down. Again, prices are still up 1.7% nationally year over year, and again, different pockets. Whether it's West Coast, East Coast, Midwest, those are going to be a little bit different. But in general, bigger cities have been doing better than more rural areas. But with depreciation, if we get 3 or 4 months like this, which we don't expect, then that's when maybe we start seeing maybe the year over year number turns negative. But not expected, just kind of slowing. And again, that has a lot to do with mortgage rates being high, anxiety about the economy, things like that. Initial jobless claims. Normally we get that today. We don't know. We don't know how many more people filed for unemployment since last week because the government is shut down. So once again, one of those job reports that we aren't going to get. So we won't have an idea of what's happening, which again is pretty frustrating. Next thing, average 30-year conventional. We're about 6.36 today, according to that lender survey. Last week it was at 6.39 after that jump, after they the announcement and things like that. So again, kind of down where we were, not as down as low as we got, but holding the gains we did. We kind of held the line at that, got to the 6.39 number and it hasn't got higher than that. So we're going to really have to pay attention to what upcoming. But like I said, the problem is we're not going to get a lot of reports. BLS jobs report unless something changes, and today I'm assuming pretty quickly we're not going to get that tomorrow. On the 15th, we're supposed to get CPI from the government, inflation. We're probably not going to get that unless that finishes before then, and then the Fed will be meeting on 10/29. So not getting a lot of these reports the Fed relies on. Maybe they can still see these numbers, but at least the general public's not going to get these numbers. However, right now the markets are pricing in a cut at that meeting. 100% chance they're going to cut. This government shutdown's actually helped us on that accord. And then the next meeting in December, they have actually 88%. So again, government shutdown is annoying. We're not going to get the reports we need, but it looks like it might be playing in our favor as far as how the markets see what the Fed will be doing going forward. So we're going to have to keep an eye on that. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.